Hi, I'm Chip Rogers, and welcome to the AAHOA Educational Experience. This week we're talking about bank workouts, what's possible, what's not possible, and how you can help yourself by going and talking to your banker. Joining me this week is Lawrence Lloyd, Managing Director of Delta Capital Group, and Brad Mead, President of Delta Capital Group. Thank you, gentlemen, for being with us.
Thank you.
So I'm in a position now where I've finally come to the conclusion that I'm not going to be able to continue to pay all of my bills, including my mortgage, at the same rate I've been paying, that the economy is just at a point where I'm not going to make it. So I finally made the decision that I would like to restructure my loan. Do I walk into a bank with my lawyer and say, here's my lawyer, since I've signed these legal documents, surely I need a lawyer to go with me, right?
No, actually you don't. You know, what you're talking about is an economic problem, not a legal problem at that level, so no. So the advice is not to get a lawyer involved, because remember, if you bring your lawyer in, then the bank is required to bring its lawyer in, and the conversation ensues between the two lawyers. If you stay, you know, working from a basis that this is an economic problem, it's a conversation between you and your lender in the beginning, and maybe at some point you and the workout group at the bank. And you can also come and get some support, you know, and there's a variety of ways to do that, and then move forward with a conversation towards restructuring.
And really, when you get two lawyers involved, number one, the expenses go up dramatically. But it would seem to me, if you have your lawyer and their lawyer, you're arguing about the old loan documents. What you're really there to get are new loan documents that reflect the reality of the economy we're in and the reality of what you can afford to pay going forward to make your loan a serviceable loan. Is that right?
That's correct. And also, when you get two lawyers in the room, they tend to do most of the talking. And they tend to talk about legal things, because that's what they're trained to do. And there is clearly a legal predicament that is on the horizon. But if you solve it as an economic solution, then you prevent that legal predicament. We used to do a series of seminars in the late 80s, the last time there was this big meltdown of banks and hotel properties. And it was called How to Survive with Your Banks. And we'd do it all throughout the country. And we'd rent a hotel meeting room. And we'd have people come in, we'd do a large mailing, and they'd come in, and we wouldn't even give them name tags. It was like an AA meeting, you know. People would kind of slink in because they had a lot of debt. And by the end of the meeting, after 2 hours, they were slapping each other on the back saying, I got more debt than you, because they understood that they were not unique, that it was not a shameful thing to have too much debt. It was a function of a lot of things, some of which might be under your control and might not be. But one of the things we used to say in the seminar is, when you guys got into trouble with your bank, how many of you called your lawyer? And they'd all raise their hand. And we'd say, why didn't you call your dentist? And they'd all go, well, why would you call your dentist? Why would you call your lawyer? You don't have a legal problem yet. You have an economic problem. You call your investment banker. Now, that's a shameless commercial, but at the same time, the problem is when you sit down with a bank and you say, look, I've got this problem. We need to restructure. The alternative is you have all the legal rights, Mr. Banker. We signed those away in that mountain of documents that we signed at the close. And so we concede that you have all the legal rights, but at the end of the day, why do you want to own a hotel? That's not your objective. And so let's figure out a way for you to get back 60% of your loan instead of maybe 30% that you'll get if you foreclose. The argument is no longer about 100%. That's gone. A lot of people are concerned about the issue of personal guarantees, because they go, well, that sounds great, guys, but I got personal guarantees that I've signed. In 25 years of doing this, we've seen personal guarantees exercised twice, and that was for fraud, where there was a clear instance where somebody was trying to abscond with money or send it out of the country that they had plenty of cash. Most of the time, the personal guarantees are there to make sure that you stay at the table. Frankly, most of the AAHOA members that we've met and that we're working with, to the point that you made before, they've exhausted all their cash. They believe very strongly in holding on to their property, and they found other sources of money in order to pay the loan even when the property didn't. That's a huge dilemma, and if you find yourself doing that, eventually you exhaust all those sources and you've still got the problem. So our advice is, as soon as you start borrowing from friends or family, or you taking it out of other resources, that's the time to start the restructure.
And from a banker's perspective, Lawrence, they don't necessarily want the first person they contact to be an attorney either. I would assume that the banker would prefer to work it out with you. They certainly recognize that this is an economic problem, not a legal problem.
Exactly, and to my point earlier, soften it up a little bit. Call your banker and say, I'm having some problems. I'm going to be contacting you in a week or two. I have started to put together a strategic plan for the property. I want to talk about it, and that will loosen it up. If you come in with somebody, even an investment banker, by your side, that could be a hammer over the head, and the banker might say, well, why didn't you call me? We've had a personal relationship for 6-7 years. I wish you had spoken to me first. So just to soften up the process a bit.
And what you don't want to do, I guess the worst case scenario, would wait until you get that notice of foreclosure, because by that time it may in fact become a legal problem, and then you're going to have to hire an attorney to answer the claims made against you, and then it becomes very expensive, because every dollar you pay the attorney is one less dollar you can put into the workout deal.
Right, but if you do get the foreclosure notice, remember, any process a bank starts, they can stop. Okay, and so it's not infrequently that we get a call from a client or a new client that says, hey, I've heard about you guys, and I just got my foreclosure notice, what do we do? And we say, well, the first thing you do is fax it over to us so that we can read it. And then typically what we'll do is we'll call the banker, and we'll say, tell us where you are in this, Mr. Banker, because we just come on the scene, and we're interested in seeing if we can work this whole thing out, because at the end of the day, if you end up owning this property and reselling it, it's going to sell for a whole lot less than if it stays with this guy who already owns it. So let's see if we can come up to some agreement. The banker may say, no, well, look, I've spent 2 years negotiating with this guy. I'm done. I'm taking him down. But not very often. Usually they'll say, well, we just wanted a conversation. We just wanted to start talking.
And maybe part of that answer is that the property gets deeded back to the bank, but it's done in an organized fashion in a consensual process where the bank takes the property back. Maybe the owner even runs the property for the bank while it's going through the sale process, and in exchange for that there's a release of the personal guarantee. So the bank takes the property back, sells it. To some extent they're going to take a haircut on that transaction, but the owner can walk out without any obligation.
And I think that's important to point out that, look, the property's worth what the property's worth. Exactly. The new owner is not going to pay 40% above the actual market value. And the bankers certainly know that. So right. Whether it's hotel owner A or hotel owner B, they're both only going to be able to service a certain amount of debt associated with that property.
Yeah, and we're seeing changes in the appraisal process too, because years ago, before the crash in 08, we were seeing appraisals where the appraiser in his report would talk about a stabilization rate of revenue in the hotel, and it would create X amount of cash flow, and that's what they would appraise the hotel off of. Now, we're not seeing that anymore. It's back to the old method of looking in the rear view mirror, looking at 24 months of trailing EBITDA, and calculating a value based on that. Of course, that's going to be a lot lower today, given the decline in revenue over the last few years.
Well, we are talking about bank workouts, what's possible, what you can do to help yourself, and we've got one more segment to talk about it. We'll be back right after this. Hi, I'm Chip Rogers, and welcome to the AAHOA Educational Experience. We are talking about bank workouts and what is a realistic opportunity for you. What can you expect in working out a problem with your bank? Joining me this week, Lawrence Lloyd, Managing Director of Delta Capital, and Brad Mead, the President of Delta Capital. Brad, so I'm in the midst of a workout, and during any good negotiation, you get a starting point, which is going to be probably much different than your ending point. But if you are a hotel owner, and I know all of these are probably different, every workout's I'm sure unique, but what is a realistic expectation of what you can work out with your bank?
Well, the answer to that comes in a couple of parts. First of all, you need to know where your bank is in their business. Banks react differently according to what's happening to their bank. We subscribe to a rating service that allows us to see what every bank's balance sheet and income statement are. That's public knowledge. And once we understand whether the bank is a 5-star bank, very strong bank, or a 1-star bank, meaning they're getting ready to go under, that will change the strategy in which you approach the bank. If they've got a whole lot of defaulting loans, they're going to be under tremendous pressure. If they don't have a whole lot, then they can do some other things for you. So knowing who you're playing your poker game with is the first important thing. The second thing is to understand what your position as the borrower is. Do you have lots of other assets? Do you have $1 million stock portfolio? If you have lots of those things, well, then it's going to be tougher to get a good deal. If you have nothing, if the only asset you have is the hotel, or like many AAHOA members, 15 or 20% ownership in 30 other hotels, then you don't have any assets that anybody's going to want to go and get. And so what we say to the banker is, look, here's the personal financial statement. There are no assets there to get. This gentleman, the current owner, will pay more for this hotel than you will get in an auction, guaranteed. And we will make that case with a large analysis. And nobody will pay more for a hotel than the guy who already owns it, because he loves it. And once the bank is convinced of that, they will go ahead and do the right thing in terms of restructuring the debt. Or their other option ultimately is to take it into foreclosure. There are some banks that will do that. They will shoot themselves in the foot. They're not very successful banks, and they eventually go under themselves. The really smart banks will work out an arrangement so that you walk away still owning the hotel, they're out of the loan, they've taken a hit, but they haven't taken as bad a hit they would take if they had to run up a lot of legal costs and go through a foreclosure.
And I think that's crucial to understand, is that, again, going back to what we talked about earlier, the bank's only going to get what the actual property is going to bear in a free market. And any additional costs that go to attorneys and going through that process is just unwarranted and unnecessary expenses, because, as you pointed out, the current owner is probably going to pay more than anybody else in the free market would.
Right. Well, it's important to remember that anything that's done in a bankruptcy proceeding can be done outside of it on a consensual basis. So if a property did go to bankruptcy and it goes to federal court, the first thing the judge is going to want to know is what's the value of the asset. And if it's a $5 million loan and the appraisal comes back at $2.5 million, well, guess what? That's the value of the property. So the judge could actually do a cram down in that process in bankruptcy and assign the mortgage level at $2.5 million, put the other half of it in the unsecured creditors pile, and it probably gets paid off at 10 cents on the dollar, maybe at some point. So there it is. So we're talking about advancing that kind of a result through an economic process rather than waiting a year or two and doing it through a legal, expensive bankruptcy process.
Do emotions get involved in this? Do whether it be the property owner get emotionally attached or the banker get emotionally upset with the property owner? Does that play into this, or does that usually weed its way out by the time you get to the end of the process?
It's very large at the beginning, because the banker inevitably feels that the property owner either isn't running the property right, or that they're taking cash and they're shipping it back to some other country. That's almost universal. Fortunately, in the hotel industry, you have the star reports. So if you're a franchise hotel, there's actually a report card that shows whether the owner is running it reasonably well compared to his group, his comparative group. What we also find is that the owner looks at the banker and he says, look, I need some help. And I've been paying you religiously for 20 years, and now all of a sudden I need some help and you're not there to help me. Well, the owner's got to remember that that was his part of the bargain, was to pay every month, okay? So, and there are a lot of AAHOA members that are very concerned about saying, well, look, I agreed to this, I'm on the hook for it, and I should pay it. And that's fine. But if you can't pay it and you run out of other resources, something's going to give. And if you get a restructure and you subsequently down the road make millions of dollars because you're a very smart businessman, you can always pay the bank back later. They'll take your money. Okay, so don't feel that you've undercut some moral principle. Most of the banks in this country have received incredible amount of taxpayer support through the TARP funds, through the various workout mechanisms. So as a taxpayer, you've already supported a lot of the banks. You'll probably be supporting them again, because there's a lot of work out still to be done. So don't feel bad about having to change the terms of the deal. But do that in an honorable way by having the direct discussion with the bank and working with them. And they'll usually come around because it's in their interest to do it.
And it's important also to recognize, as the property owner, that the bank made a loan based on some evaluation of risk. It wasn't a 100% guarantee, because if it was, then your interest rate would have been 1%, not the 6% you paid.
Sure. Well, and remember this advantage too. The bank already gave you the money; they're trying to get it back. So it's a conversation about how that ensues from the point you are at today going forward.
And in workouts, I've heard this statement recently. You were talking a moment ago, Brad, about the health of certain banks. Someone told me that cash is king. Anything you can put up on the table to help get something worked out is something that they really value, far more than a promise of future revenue. How does that play into negotiations?
Well, and it also depends, again, on the bank. We're working with a lot of one-star banks at the moment. These are banks that aren't going to be here in 6 months. They have huge loan losses. The FDIC is going to take them out. This is a terrific opportunity. If you happen to be lucky enough to be with a one-star bank, you're going to be in a position where you have a lot of leverage over that bank, because what you do could literally drive the bank under that next day. And so, again, determining what you want and what you need and what the bank needs, cash is a huge issue, but at the same time, just being out of the loan or being able to bifurcate the loan. There's something called a FASB, F-A-S-B 15. That's a loan bifurcation. That's where the bank is encouraged to split a loan into a Part A and a Part B, what you can afford and what you can't afford. And that's a process that if you put it together, now all of a sudden the bank has at least Part A that they can return to performing status. So there are ways that you can fix the banks. The banks are heavily regulated. And once you understand those regulations, you can fine-tune them and you can play them a little bit like an orchestra. And the banker will respond to that because, again, his principal goal is not your workout. His principal goal isn't to make you happy. His principal goal is to stay employed. And so he has to develop all those solutions through a process that is bank approved. And if you respect the process, they'll help you.
Couple comments there too. The same rules apply for credit unions. So if your lender is a credit union, it would be the same kind of process-driven thing. And then also Brad was kind of hinting at, but maybe the restructure is a note purchase. So that if you have a $5 million note and it's determined that the property is only worth $3 million, you may pay a premium for it, but maybe you buy that note for $3.5 million. The bank gets a premium over the value of the property, which makes them look better. You know, if they took the property over, maybe they'd only realize $2.5 million from a sale. So, you know, it's a better situation for everyone, and you've eliminated $1.5 million of debt.
So as we close out the show, to the AAHOA owner that's watching us says, all right, I sense that I may be in that position and I may need a workout specialist. But you know, now I see there's 10, 12, 15 people that, because this is becoming obviously a much needed skill these days, 10, 15, 12 people out there offering their services. What should our members look for? What should an AAHOA member look for when determining who they're going to work with? Well, look for references. That's always a good idea. We have lots of references. We're on the AAHOA website, so you can find us on there under advisors. And make sure that they've done a lot of it. This is kind of a specialty. We fell into it 25 years ago. We've developed into a real specialty. We're not aware of a whole lot of people that do this. Lawyers oftentimes will tell you that they do it, and they do at some level, but they're handicapped by the fact that they can only talk to the bank's lawyer. They're not permitted by their little sanction to talk to the banker, and that's a huge handicap. You want to be able to talk to the banker. He's the guy making the decisions. He's the guy in the boardroom that's deciding what to do. So, so those are some good guidelines. Just check references. Probably 20% of our business comes from bankers who tell their borrowers, call Delta, because we'd rather deal with Delta than your lawyer. Because again, they're looking for a solution too. The banks that understand this process understand they're not going to get 100%, but they want to get as much as they can, and we can help them achieve that objective to the benefit of our client as well. Absolutely. Well, gentlemen, thank you so much.
Thank you.
It's been a wealth of knowledge you've shared with us today. So for Brad Mead, President of Delta Capital Group, and Lawrence Lloyd, Managing Director, again, thank you for being with us these last 3 shows. I'm Chip Rogers. We hope you enjoyed the show this week. If you'd like to reach me, you can email me, chip@AAHOA.com. That's chip@AAHOA.com. Thanks for watching, and we'll see you again next week.